Hi, good evening, everyone. Let me introduce myself. I'm Tommy from Phillip Futures, and I will be your host as well as the speaker for the second session of the tonight's webinar. Thank you so much for taking time to join for us for this event with the themes effective strategies in navigating the crude oil market. This webinar is also supported by CME Exchange, and we are very fortunate to have an amazing speaker, David the proprietary trader with us. Hi, David.
Hi. Hi,
Yeah.
Tommy. Yeah, hi.
Before we start, I would like to share tonight's agenda. We have 5 sessions. The first one is opening, and the second one is main topic, second topic, and Q&A and closing. Okay. Now to keep things moving, let's watch a short company profile video from Phillip Futures. Hmm.
Phillip Capital merupakan gabungan perusahaan layanan finansial yang didirikan pada tahun 1975. Kini, Phillip Capital telah tersebar di 15 negara dengan headquarter-nya yang berada di Singapura. Negara-negara lainnya adalah Indonesia, Kambodia, Malaysia, Thailand, Vietnam, China, Hong Kong, Jepang, Australia, India, Turki, Uni Emirat Arab, Inggris, Prancis, dan Amerika. Sebagai member dari Phillip Capital, PT Phillip Futures merupakan sebuah perusahaan pialang perdagangan berjangka komoditi yang berada di Indonesia. Phillip Futures telah bergabung sebagai anggota clearing Indonesian Commodity and Derivative Exchange atau ICDX dan Jakarta Future Exchange atau JFX untuk ikut serta dalam mengembangkan perdagangan komoditas di Indonesia. Phillip Futures juga terdaftar di Bapepti atau Badan Pengawas Perdagangan Berjangka Komoditi dan memiliki izin penyaluran amanat luar negeri atau pasar berjangka asing. Dengan izin penyaluran amanat luar negeri, nasabah dapat bertransaksi lebih dari 100 produk seperti indeks, komoditi, dan mata uang di berbagai bursa global seperti SGX, CME, CBOT, NYMEX, COMEX, ICE, APEX, HKEX, IFSG, dan DGCX. Misi dari Phillip Futures adalah membantu nasabah untuk mencapai kesuksesan finansial di pasar komoditas dan derivatif. Phillip Futures, bringing global markets.
After that, I will share a bit about our company and its global coverage. Phillip Futures, as a member of Phillip Capital, PT Phillip Futures has been a registered clearing member of the Jakarta Future Exchange, JFX, since 25 and has been registered as a clearing member of the Indonesia Commodity and Derivative Exchange since 2010 to participate in the development of commodity trading in Indonesia. PT Phillip Futures is registered with and supervised by Bapepti. Globally, we are present in 15 countries with our headquarters in Singapore. We proudly serve over 1 million clients, manage shareholder funds of 2.5 billion USD, and oversee asset amounting to 35 billion USD, supported by a team of our 5,000 professionals. After that, let's welcome David to kick off the first session.
Yeah, okay. Thank you,
Yeah.
Tommy, for the introduction. So I'm just going to share my slide.
Yes. Please.
Just want to double check. Are you able to see my slides?
Yes.
Okay, that's great. Yeah. Okay, thank you. Yeah, so I before I start, just like to thank the audience for joining us tonight, especially on this topic entitled the crude oil market. So if you have been trading the crude oil space you do notice that the volatility of the crude oil prices in the past couple of weeks, or even in fact months, has actually been quite volatile. So as a trader, we like volatility. Is when markets are volatile, that's where opportunity presents. So I think it's important for us to talk about crude oil, given that there's a lot of factors that's affecting the oil prices. And I continue to believe that I think markets in crude oil is going to get more volatile. So as a trader, we really need to, to familiar yourself with our strategies, especially whether you look at things fundamental or looking at charts in terms of technical setups. So I'm just going to continue with the presentation. So before I start, just like also to extend a very thank you to Phillip Futures as well as CME Group for inviting me to speak on this topic. So just before I start, I want to put out a disclaimer. I think anything that I mention or present today is purely for educational purpose. Even in fact, opinions are mainly reflecting my own personal opinion. It doesn't reflect opinions, whether it's from Phillip Futures or whether it's from the CME Exchange group itself. As Tommy has mentioned, dealing with futures is an important instrument, but it's also a highly risky instrument as well. So make sure you get necessary information before you start trading in the futures market. I believe Phillip Futures, you're in good hands. Phillip Futures have experienced staff members that can able to give you the right education to start your journey in trading the futures market. Now, this is what we're going to cover in the next 45 minutes or so. I think it's important that, with any other commodities, whether it's talking about crude oil, or grains, or even palm oil, for example, I think it's important to assess what is the current supply and demand situation in the particular commodity. So basic economics, if you have high supply situation, normally prices will be low. If you have tight supply situation, normally prices is going to rise. So we really want to see, as we go into the last quarter of the year and into 2025, what will be the supply and demand dynamics is going to play out. Now, if you are trading oil, obviously you need to talk about OPEC. OPEC is basically like an oil cartel. Now, if you've seen over the news in the past couple of months, why oil prices has actually came down and why oil prices did not fall into a certain price level, but has been maintaining between an average price of about 70 to 75 US dollar per barrel. I think that's also because of OPEC function in the market. So it's very peculiar, but we must acknowledge the fact that, OPEC is an important factor to drive oil prices. Now, I just want to mention a little bit on oil and equities market. Although there's a bit of relationship in there, but sometimes it doesn't really move in parallel. But it's important also to highlight the fact that, when you look at oil, it's also important to look at where equities market play is. And it's interesting because this time now we see that equities markets are at all-time high, especially in the US equities market. But you see oil prices doesn't really follow along. So it goes to show that there's something missing here in terms of the linkage here. And it's worth to pay a bit more attention to it as well. The last session of this webinar, I'm going to mainly cover on certain technical strategies that you can use whenever you look at or whenever you want to navigate the oil market. Now, technicals are important because especially when it comes to risk management, if markets are very volatile, you must make sure that you have a way for you to manage your risk. And the livelihood of a full-time trader like me, it's all about risk management at the end of the day. So we must make sure that we have a way to get ourselves out in case we are wrong. And most of the time we can be wrong. There's no such thing as market can always be in our favor. So keep that in mind. I'm just going to share certain practical skills, practical tools that you can use to, especially when it comes to risk management. Now, I just want to share, these are the factors that drive oil prices. Obviously, this list is not exhaustive. There's many other factors that's not mentioned here. But I think what I list down here is the major key factors that actually drive oil prices. So first thing is always look at supply. Supply of oil is very driven by OPEC, which is a cartel. And I think in recent times, we have started to realize and see and also observe that, US, which is a very major, big supply of oil supply in the market, is gaining prominence. So that comes to a question whereby is OPEC still relevant given that, many of the non-OPEC, especially US and many other countries, oil-producing countries, which is not OPEC aligned, is slowly starting to produce more. And because OPEC itself as a cartel, they try to reduce their supply because they try to support prices. So it's going to be a tug of war between the OPEC and non-OPEC, especially the US. And it's interesting to watch, I think, the next couple of months, whether how things is going to develop, whether finally OPEC will finally give up its tug of war and finally start to pump supply into the market. So OPEC itself is an important play and it's worth to watch going into 2025. Now, second thing is obviously demand. If you have strong supply but you don't have strong demand, it's going to be a problem for price. So globally, really, is there's a lot of uncertainty. Obviously, next week is crucial. We have the US election in play, and that whoever wins, whether it's Trump or Harris, wins the presidential race, is going to be determine the trajectory for the oil market as well. Now demand next year is generally going to be quite neutral or probably likely more on the downward side because many of the developed countries are still quite struggling, especially with China. So global demand is not to say too optimistic going to 2025, but it's worth to pay a bit more attention. If global economy starts to deteriorate or you don't see any positive sign, I don't think oil prices can sustain at this level right now. So it's really going to be focused on not only supply but demand as well going into next year. Now, interest rate policy is also important, parameter because ultimately, we are now talking about, winding down of a hike in interest rates. Everybody's been talking about when interest rate is going to reduce. Now, US has started the rate cycle down. They started to cut by 50 basis point in the last FOMC meeting, and it's projected to cut more. So it really goes to show that shows that economy is weak. Generally means demand is going to be weak. So interest rate in a way is in a sense tied to oil prices. But I can say that once inflation start to be a concern, you start to see interest rate policy changes as well, and that will also affect oil prices. Now, economic growth is fundamental to demand. So next year, really, are the key countries you should look at is really looking at China being a very large country and a large consumer of for crude oil. So obviously, that is a factor to watch. Now, geopolitics. Geopolitics is a nightmare for oil traders. No, if you are trading oil, normally you don't hold positions overnight or over the weekend. Reason being is because right now you are facing a lot of headwinds in terms of geopolitics. We have the Middle East tension. We also have the Ukraine and Russia conflict. Now, all this conflict can get more intense, and it will likely get more intense. And once that US election win has settled down, I think the main focus will be right back in geopolitics. So going to next year, in fact, early part of next year, really, as an oil trader, we really have to watch the geopolitics, and it's something that's not predictable. You never know when all of a sudden the conflict can get more intense, and that will really drive oil prices. So do watch out. I think the Middle East conflict is something that we really need to focus. And eventually, if you're someone that don't like risk in the market, try not to hold your positions overnight, especially for those holding over the weekends. Now, the last bit is talking about green energy. I know this is a common theme now. Everyone is talking about ESG, sustainability. Even for Indonesia, you're going into more biofuels mandates, which means there's more green energy usage and less dependent on crude oil. Now, would that really take demand off from crude oil market? It's quite unlikely for the near term, but in the mid to near longer term, is probably going to change a different scenario. So these are the key things that we really need to look at. But as a trader, if you're looking at short-term point of view, the green energy transition is not going to be a big impact until a later period. Now, so this is what we see going into 2025. I think oil looks like it's going to be slightly more bearish, given the fact that I think the forecast for the global demand is going to be weak and supply is coming on stream. Keep in mind, why supply is coming back is because OPEC as a cartel, they can no longer keep restraining supply. They can't keep saying, hey, no, look, we should control our pipes. Don't let too much oil into the market. They can't do that for long. Reason being is because if you do that too long, US is catching up fast. They are now the largest producer of crude oil in the market, and they are not OPEC member. And they are benefiting high prices because even at 70 or 75 US dollar per barrel, majority of the oil companies in US are still making money. So I don't think OPEC will want their position to be threatened. And I don't think that OPEC are willing to just give market share over to US. So as a result, I think coming first week of December, there'll be a decision where OPEC will make a decision whether will they continue to cut supply of oil in the market, or they slowly start to release supply. And keep in mind, they are releasing supply when economic conditions are going to be getting worse. So eventually there will be a potential glut in the market, and that will really weigh down on prices. And this is what we are looking at first quarter, second quarter into 2025. This is what IEA has reported or even projected next year. Now, just to give you a context, you can see, this blue line is very evident. The largest producer was always the Saudi. And I think eventually they gave their status, their number one status over to US. And you look at how the rapid rise in US in terms of oil supply over the past 2 decades. Now, why the sudden speed, or how they achieve such a tremendous growth is because of shale fracking. That technology has helped them to supply a lot of oil into the market. So from a net importer, they've actually become a net exporter. And that's why US has continued to dominate the number one spot in terms of energy supply. But keep that in mind, that is also because Saudi is also trying to constrain their supply to make sure that they have a good oil prices, because whether that is to fund their budget or what, but that aside, so we really can see evidently US is currently the number one producer in the world in terms of crude oil. Now, despite the gloomy forecast we are seeing in terms of next year, a lot of the IEAs, the Energy Commission, they're looking at quite a gloomy forecast or bearish forecast next year. But if you just look at the fundamental stock levels, global stock levels in terms of oil is actually quite low and quite tight. Whether it's because I think demand is still there, supply is tight, so they're just trying to redraw down their inventory. Now, eventually, this is going to be a concern. If demand starts to pick up, or there's a sudden surge in demand, we're going to have a problem. There's not enough stock to really buffer such a surge in demand, and eventually that will drive prices. So this is a bit of a positive narrative that we can see. Now, whether this drawdown in inventories will continue, I believe is very likely, given that, as long as you don't see OPEC aggressively try to pump supply into the market in the next couple of months, we should see drawdown in stock levels in totality. But it's worth to pay attention. I think despite we are seeing what OPEC is doing and gloomy forecasts about global demand next year, we should take note that inventories around the world for oil is actually very low. And that's a good thing, because as long as you have low stocks, any surge in demand will really drive oil prices. So this is just to emphasize again, I think US inventory is actually very tight right now. And that's on US perspective. You look at globally, besides US and even look at Canada numbers, a lot of major countries, their oil stock levels are actually quite low, except for China. I think China is for strategic reasons. They want to accumulate oil reserve. But I think that's a whole different set of purpose. But I think in general, global stock levels for oil is actually very low. Now, this is you look at where this is in Cushing oil. WTI Cushing is one of the major hub for oil in US. You can see the stock levels are actually slowly dwindling down. Only in recent weeks, I think they start to power up, because they start to notice that, hey, look, inventories the stock levels are way too low. They can't afford to have such a small inventory to buffer in case of any surge in demand. So really, I think right now the market is noticing that, hey, look, inventories are tight. Despite the supply and demand dynamics may be not favorable, but I think it's time for us to start to store up oil in their reserve. And because of that action, I think that also support prices for quite a while. Okay, so now this question on oil likely to be the peak in oil. I'm not going to go too deep on this topic, but what it tells you is that a lot of people will say, hey, look, people are doing green energy, EV cars are popular. There's no one going to use diesel and gas powered. What is likely to see is that the EV segments or even the car segments are still generally quite a small market. The heavy usage are mainly the industrial for energy demand, and also the jet fuels. Jet fuels demand are still pretty strong. So I would say that the oil may likely to be peak in probably in a decade or 2 decades or so. It's still quite a long time, but definitely not in a couple of years. The demand, the generation of energy is still very high. And now obviously people are talking about data centers. Data centers, they need a lot of energy. So with that, oil as an important energy product is still heavily demanded. So this one I'm more afraid of, and it's interesting to observe. I think I think US has actually sustained the #1 position for quite a long period. And it's overtaking Saudi for I think couple of years now. The reason being is because again I mentioned the shale oil technology is making more efficient for all the oil producers to produce oil in US. And I think secondly, Saudi will just want to maintain a high oil price, and how they do that, restrict supply into the market. Now, it's going to come to a point where they start to realize, look, they are not going to gain a lot of market share by doing this. They are giving away the market share over to US. And the key question is, or are they comfortable to do that? If they are not comfortable, we're likely to see, Saudi and the rest of OPEC countries will really start to put supply into the market to try to gain back the market share. And when they do that, I think oil prices will definitely take a shock. So watch out. I think OPEC decisions coming first week of December is going to be quite crucial. And eventually, I think they need to signal to the market whether are they going to slowly start to put more supply into the market, because they don't want to shock the market. If they shock the market, I think that's you're going to see a lot of volatility in the market. Now, the outlook for US when it comes to production, despite their #1 right now, if you look at it medium to longer term, it doesn't look good. The reason being is because oil is an industry where you need a lot of capex. You need to explore more, you need to do exploration, and all this involves money. I think it's for a long period, a lot of these oil rig companies in US, they are actually well comfortable because of the high oil price that they're enjoying. So a lot of these companies, they don't really spend on capex. What they do is that they get any excess profit they make, they actually return back to their shareholders. So in a way, they don't spend a lot on R&D or capex spending. And as a result, really, you look at over the longer term picture, I think US supply probably has peaked in the next couple of years or so. Now, shale oil, despite this technology is efficient, there's how much only you can produce, and there's a limit to it. So I think US going on a medium to longer term forward, supply is going to be restricted. So it really all depends on the OPEC countries. We still have enough, reserve underground or even on seabed level to extract for at least the next 1 or 2 decades or so. So I would say the supply dynamics will probably slowly shifting over to OPEC, and they become more relevant in time to come. But for now, I think US remains a top spot. So you want to understand how the supply and demand dynamics, look at where US supply is, and obviously look at what OPEC decisions, because that ultimately will drive prices. So this is what I meant. If you just compile all the statistics and you look at where some of the US oil rig companies, like I mentioned, 70 to 75 is well comfortable. I would say easily about 90% of all the companies that's in the oil industry are making good money. Now, if oil prices fall below 60, then you're looking about 80 to 75% of the oil companies. So at least 20% of companies won't survive and they'll be out of the market. And as we go lower, probably around 50, you're talking about easily 60% of the industry will only survive, which means 40% will definitely be out of the market. So a lot of break-even points, but as oil prices go lower, you can start to see supply dynamics start to change. It means a lot of oil companies will start to shut down. There's no incentive to produce, and that will restrict supply in the market. So watch out. All I can say is, I personally don't think that oil prices can go below a certain level. In fact, I think below 60 is actually very commendable. The market is too bearish, because eventually companies will start to realize, look, below 60, they don't make money, and then eventually they will just stop supplying. So that's something for us to take note of. I think it's important for us to at least know where the support of the price support is for the oil market. Now, this is just going through the list of the top 10 largest oil consumers. So you can clearly see United States is one, obviously by demographic and the population size, but obviously the second and third largest also again is logical given the population size of China and India. So really, I think you want to look at where factor of demand is, you have to look at China and to a certain part, India. Now, India, I don't going to go too much on it. I think the country as a whole is doing well, but except China. So China is very struggling. And I think if this continues to next year, if the government is not stepping in aggressively enough to support the economy, I think that would drag oil, that oil demand as well, because economic sentiment is no good. That will also drag the sentiment of the oil market. So I'm not going to touch too much on China, but I think the outlook itself is quite tricky and is quite critical. Now, definitely the target for GDP this year, this is the last quarter. So numbers in the next 1 or 2 months are going to be critical to see whether can China hits the 5% GDP growth target for this year. A lot of people are saying it's unlikely, given that what we have seen in the pace of the economy in the past 2 quarters. It's not likely for China to hit the 5%, and probably this is one of the few instances where they missed their annual GDP target. Now, having said that, I think the government is starting to realize the impact on the slowdown in economy and is starting to do something. The only question is it enough? The way I look at it, and how the way we see the market, if you look at how the equities market has been performing over the past few actions, post actions, we can see that the equities market still demand that the government do much more in order to pump prime the economy. So it's going to be a very volatile element looking at China going into the 2025. I think that's going to be a key area to watch out. If China continues to see drag in its economy, I think that will really be something to put a stopper in oil prices. Now, you can clearly see here, over the past decade or so, every time when China starts to see slower growth, or there's no negative growth so far, but it's more of a slower growth, you can see oil prices also starts to decline, given the fact that China is a very big consumer for the oil market. So these are the dynamics that we see in the demand perspective. So if you want to see where the demand for oil is going to be for next year, just look at China. If China continues to do badly in terms of their economic momentum, I think that will be a drag for oil prices. Now, this is what I meant. A lot of refineries in China, I think they'll probably be suffering quite a while, since early last year, even in fact, middle of last year, throughout the whole of this year as well. Just that only in recent weeks, after the post-action where they actually reduce or cut massively on their interest rates just to try to support the economy, we start to see there's a bit of a surge in demand for oil. But other than that, I think throughout the whole year, China economy has actually been slowing quite gradually, and that actually impact oil demand. Now, this is what I meant. I'm still quite positive overall for the demand story for oil, is because despite you're seeing a lot of adoption of green energy or EV cars, the jet fuel demand, which is a very big component, remains solid. And in fact, I think the levels are pretty much going back to pre-pandemic levels. In fact, this year probably you can surpass pre-pandemic levels. And if that's so, really, I think that's also a key driver to oil prices. And I think, despite you're seeing slowdown in China, which most likely will impact the oil demand, but in other areas, the jet fuel strength or the growth demand for jet fuel is going to be something that can compensate the slowdown that we see in China, and hopefully that can sustain, and eventually that will be a way to probably, whether it's to support prices or to drive prices higher. Now, obviously you have been trading the oil market for quite some time. You notice that the past couple of weeks has actually been very volatile. We have a lot of news flow, especially from geopolitical side, the Middle East. And if you have been trading the oil market, I'm not sure whether how many of you here are actually trading the future space only, or if you have ever dabble in options. Options is a very good market to look at, especially when you want to minimize your risk. There's a lot of option strategy, and options on CME is actually very liquid, and therefore it enables you to actually better position, or you can use or efficiently use your risk, or diversify your risk. So you can see that the interest in the options market, especially for the crude oil space, as in recent times, actually been gaining momentum. So it goes to tell you that I think the volatility in the oil market is going to stay for quite some time. So if you are trading this oil market during this period, you have to be very careful. Make sure you have your entry and your exit plan accordingly. Because when market gets volatile, that's where you can probably capture opportunity, but then again, you can also be a position where it's not favorable to you, and that's where you really need to cut, or you have an exit plan in place. Now, I just want to share with you this concept. I know for those who are new to the futures market, this may get a bit more complex for you, but I think just bear with me. So if you look at the future space, especially the oil market that is on the CME exchange, we have contracts that's listed up to 5 years. Now, we are not keen to trade contract that is 5 years forward, or 5 years from now it's 2029. We won't know what will happen between now and 2029. So those contracts are lessly traded. But if you take, since we have every month contract that's listed, so we have the October, November, or even December futures contract listed on the CME exchange. If you take the first month, which is let's say October, and we compare with November prices, we get what we call a spread or difference in prices between these 2 months. And if you just plot it in a chart, you can see that there is a period of time where October contract, which is our current month contract, can be higher than the next month contract. And normally this happens is that when markets are heavily short in supply, or there's suddenly surge in demand, that push up the October prices higher. So therefore, that explains why October sometimes can trade higher than your November contract. Now, in a normal market, it should be November higher because there is a cost of storing, there's a cost of insurance to it. There's also a cost of transferring your oil product into the future dates, so that it's cost involved. Therefore, the further months should be priced higher. But market dynamics always change. So I will just want to explain to you this concept is because when we notice that the demand or the dynamics between the inter calendars, or we call it inter months, starts to change, that tells you that the market conditions has also changed, or rather the sentiment on the market has changed. So you can see here quite clearly. So 0, that means there's no change in your current and the next month. So anything, if you see that's higher positive, that means the current month is much higher compared to next month. So right now we're in positive territory. So it goes to tell you that the current month is priced more higher than next month. Why is this so? It's because the current month, there's a lot of uncertainty. Now we are talking about US election, geopolitics. So a lot of people are pricing in risk to the current month rather than the next month. So it tells you, despite you're seeing prices of crude oil coming down from 75 down to 70, but the sentiment on the ground, especially for the near month markets, are still telling you that there's still a tight situation in the market. So we can't be too bearish on the market space as well. By looking at sentiment, we can slowly gauge where the market players are behaving, or how are they feeling the sentiment on the market. So in short, you can see that despite you're seeing these few days, you're seeing crude oil prices starts to come down. But if let's look at the spread between the inter-months, it's telling you that the sentiment on the ground is that the near-month markets are still quite bullish, because the situations, the stock levels are still tight. So any surge in demand will probably bring prices higher. So that's something for us to take note. If you are new to a future space, I think this is a good tool for you to look at to assess market sentiment. Now, coming into politics, especially US presidential election. Now, I think is as of now, because this is taken on 23rd, I think looks like Trump might have a slight edge. Still, again, it's pretty much a 50-50 game as of today. So now we are just only a couple of days away, from the November 5th election. So right now to then, I think there's also going to be a bit of uncertainty in the market. So if you ask me who's going to win, I still say it's still quite 50-50, 50-50 bet for now. But what I want to highlight is that the policies on each of the candidates is going to be widely different. Now, to keep it short, the oil market, and whoever wins, if let's say Trump wins for the second time, he's definitely going to be pro the oil producers. That means the oil frackers, the oil rigs, they're going to benefit much. And eventually, I think that will probably be something positive for oil prices. Now, Harris, on the other hand, is going to possibly or potentially continue what Biden legacy policy is regards to energy, which means that if Harris was to win, and extending what Biden has done over the past 4 years, very likely there's going to be a push for green energy. So you talk about biofuel, you talk about less usage of oil, and that eventually be something negative for oil prices. I think that's key things to look at in terms of policy measures. But again, this can change. Candidates are candidates. Eventually, if they whoever wins the presidential race determines the policy action for the next 4 years. So things can change ultimately. But again, based on what is consensus that is building between these two candidates, this is the direction that we probably can see if whoever wins the presidential race. Now, if you ask me the story of the oil, is it going to be a bullish picture, given that now people are talking about green energy? We should be moving from fossil fuel and away from energy that's not contributing net positive to the environment. Now I must say this, as if you just look at this is done by OPEC report. Even they have acknowledged the fact that the energy demand is going to get increasingly high over the years. Now you can talk about there's always alternative energy, which means like your biofuel, your wind, your turbine, or even right now the most hotter topic of interest is the nuclear energy. We have no doubt. I think the demand of energy is going to rise rapidly because data centers are building up rapidly around the world. Everybody's talking about AI revolution and all this. They are all energy intense, and they need high demand of energy. So the key thing is that I think what can fulfill the gap for now is still need crude oil. You still need mineral energy. And the key thing about all this alternative energy is always the stability that is important. So right now, I think the technology for those alternative energy is still quite lacking. But I think crude oil will still fulfill that potential for quite some time, until where we start to see there's reliability in terms of, or stability in terms of the alternative energy sources. I think that's where it's going to be impacting the oil. For now, I don't see there's a much of an impact. And as I see, energy demands will continue to grow. And it's going to be a concern. Whether nuclear is the answer, I wouldn't know. But no, there's not every country in the world can have a nuclear power station. So that's also another consideration. And I think the only solution for now is the mineral energy or the oil. So this is the prospect. This is what OPEC put it in the latest report on the oil outlook. So you look at it, I think they're still quite positive for oil, but they have to acknowledge the fact that the oil mixture or the oil demand, in terms of proportion or contribution to the overall total energy demand, is going to get lesser year by year. I think as many countries are going into green energy, climate friendly energy policies, I think sooner or later that will probably have an impact on oil demand. But I think that's still quite a long way to go. Right now, energy demand is still high. They need something to fulfill the gap, and I believe oil is quite a natural answer for that. Now, last bit on the factors part, I just want to highlight a bit this particular chart because it's in relation to the palm oil market. So if you look at it over time, that when you have high oil prices, normally that supports the palm oil market, mainly because it's used in biofuel as well. And biodiesel mandates and policies are also important to drive CPO prices. What's interesting to take note of is that recently we saw that the oil price is actually coming down, but CPO prices are still sustaining very strong. So if you are a trader that looking at both the palm oil and oil space, you need to understand that I think right now the dynamics in both markets has changed. We can no longer rely on this relationship whereby if you start to see high CPO prices, that will mean also high oil prices. There's no causation in that. So that's important to take note. I just want to highlight that point to you. If you're trading in both markets, we can't really use this relationship anymore because the fundamentals dynamics for each of the markets are quite different at this point in time. So going into the second part of the webinar, talking mainly on technical strategies. So how to set up a trading plan? Now, I just want to disclaim myself here. I'm a trend trader. That means trend trader are usually looking at trends. We are more concerned with trends of the market. So in an uptrend, if the trend is on an uptrend basis, we means that we find positions to long. Now, a lot of people get this, get this concept, or a lot of people make a mistake during a trend market. What's a common mistake is that usually when the market is trending higher, they are always trying to find position for those to pinpoint exact location to where there's a reversal in the market or there's a potential retracement in the market. Now, when the trend is strong, whether it's uptrend or downtrend, if you're going against the trend, it's never a good proposition to be in. If the trend is on an uptrend, find position for you to long. If the trend is on a downtrend, find position for you to short, because eventually, if the trend, you can ride with the trend. So in that regard, we need to have trend trading tools that you can use to try to gauge where the trend on market is heading. So there's a couple of ways to do it. One is to use a Heiken Ashi. Now, Heiken Ashi is one of my favorite candles to use. It's one part of Japan's candlesticks. So if you are someone that's using automated trading, you like to key in codes and all this, you can definitely use Heiken Ashi, because Heiken Ashi is just a calculation of using a Japanese candlestick bar. Later I'll share with you why Heiken Ashi is favorable for trend. Now, besides that, you can also use moving averages. And I just want to introduce to you a trend trading tool called DMI, Directional Movement Index. This tool is also quite critical to look at to gauge the strength of the trend and to look out for trend direction. Last but not least, in every trading setup, you need a way to manage your risk. There's no point of talking entries, but there's no proper way for it to get you out. And as volatile as it is, crude oil market is a very volatile market. So you really need to have a proper risk management to get you out in case you are wrong in the market. So one of the ways that you can look at it is what we call a tool that we call average true range, or ATR for short, which measures the range of the market on the period basis. And from there, you do a multiple of ATR to manage your position out in case the market go against you. So now this is basically the crude oil market. Now, obviously, last week we saw a strong rally in oil prices. I think it was trading above the 70 for WTI. That was in preparation for the weekend, because there's news that the geopolitical tension, especially Israel and Iran, is going to get more intense. And over the weekend we saw there's a couple of conflicts, but it was not as what the market expected. So therefore, I think these 2 days, just yesterday and today itself, we saw a retracement in terms of oil prices from the high of 74 right down to below 70 right now. So if you look at the longer term trend, the candles are still way below the 20 and the 50 mark, the EMAs, or rather, sorry, the 50 and 200 period EMAs. So it goes to tell you that longer term perspective, the oil market is still quite bearish. The trend is still down because the candles are below both the moving averages. So there's a lot of ways to look at trend on the chart. One way is to look at where the position of candle is, whether you get a higher high or higher lows. That tells you generally is an uptrend. If you get a lower high, in this case it's a lower high, and lower lows, it tells you that generally the market is on the downtrend. Another way is to plot a moving averages. In this example, we're using a 50 and 200 period EMAs. So both the candles, generally the candles are below these two moving averages lines, is telling you that the market is still on the downtrend. Now, this is where it comes, why a part where why Heiken Ashi as a candle is preferred to be used for trend trading. Now, if you look at these two charts, both of them are the same product, same time frame, same period. But what's the major difference? It's the type of candles that they use. So Heiken Ashi is your chart A, and your chart B is your normal Japanese candlesticks. Notice this. If you look at chart A, in this uptrend, you see green colored body bars. If you compare that to Japanese candlesticks, the moment you start to see green and you start to see something like a red doji, that's the first sign that you get up, because probably there's a potential reversal in the market. But Heiken Ashi will show you a green colored bar. Probably the body is smaller, but it's still green. That tells you it's still an uptrend market. Possibly that the strength has weakened, but it's still generally an uptrend market. So in short, if you use Heiken Ashi, which is chart A, it keeps you longer in the trend. And therefore it's suitable for trend trading. Chart B is your normal Japanese candlesticks. It's more to pointing reversal of the market rather than showing you trend continuation. I'm not going to go too much on what's Heiken Ashi. Obviously, you can now with Google and ChatGPT, you can always ask Google the definition of it. But I think Heiken Ashi is a great tool if you are someone that's doing automation as well. Heiken Ashi, you can input their codes, their calculation into your particular trading codes, and you can able to automate your strategy based on Heiken Ashi, and that's very flexible and useful. Now, difference between Heiken Ashi and Japanese candlesticks. Now, Heiken Ashi, there's only 3 major forms that you need to know. Japan's candlesticks, on the other hand, is highly complex. It takes skills, it takes years to master. If you read Steve Nielsen's handbook on Japanese candlesticks, he has 100 over combinations. It's not easy to master 100 over combinations. That's the amount of charts you need to look is tremendous. Now, Heiken Ashi, there's only 3 major forms. Candles are green means up, candles are red means down. If candles are short body, and a series of green and red together side by side, it tells you market is sideways. As simple as that. Now, Heiken Ashi, because the nature that is easy to quantify, so therefore it's very good for you if you're using quantitative methods to trade. Heiken Ashi is more to trend. Japanese candlesticks is more to reversal, and Heiken Ashi is based on color. Japanese candlesticks is actually based on the patterns in the market. Now, I just want to also highlight one point. If you use Japanese candlesticks and Heiken Ashi, if you notice this particular chart here, Heiken Ashi doesn't show you any gap in the candles. You represent the gap in the candle by the color of the body or by the body of the candle bar. Now, Japanese candlesticks obviously will show you there's gaps in the market. So if you are someone using gap, and normally in crude oil market, hardly you can get, it's very rare to get gaps in the market. But if you are someone who use gaps analysis, you can't use Heiken Ashi. You have to go back to Japanese candlesticks. So that's, I would say, one of major disadvantage. But if you are looking at trends, that's Heiken Ashi is a very good tool to have. Okay, so this is just a dynamic variable of using Heiken Ashi. So if the market, to indicate Heiken Ashi, whether it's an uptrend market, look at the color of the body bar. If it's green, that tells you the market is heading higher. It's an uptrend candle. And if the body of the candle is getting wider and larger, it's telling you that, the market on uptrend basis, there's strength. If the body gets smaller, or the body, or it gets narrower, that tells you generally the uptrend is losing momentum. So that's a good time for you to get out, and every time when you look at green body candle, it's usually have an upper wick. There's no lower wick. The moment you see a lower wick, where upper and lower wick appears on a green body bar, it tells you that this uptrend is slowly starting to lose momentum. So that's a good time for you to be out of the market, or you can start to observe whether there's a change or potential change in trend. Now, downtrend is the same. It's a vice versa. That means red candle bars, white bodies is definitely a strong downtrend market. So sideways. So sideways, you start to see body of the candles are very small. And usually the green and reds are side by side, almost like a doji, like a cross. So when you start to see this style appearance in the market, especially using Heiken Ashi chart, it tells you that generally the market is heading for sideways. There's no clear trend in the market. So if you're holding into a trend position, whether it's long or short, you should be careful. And that's usually be a good time for you to be out of the market. Okay, so this is basically the dynamics of it. So this is a downtrend market because you look at the red color body bars. Those body bars are wide. So it tells you this downtrend, there's strength. Now, when it comes to this section here, you start to see the bodies are getting very small, almost like a cross. And you start to see green candles appearing. But the green candles are not big. It's also small. So it's telling you the market is heading to sideways market. Only then, when you start to see the series of green body bars and the body bars are getting wider, it's telling you that this sideways are slowly moving into the uptrend market. So this is how we use the dynamics of looking at Heiken Ashi candles by judging the trend of the market. Now, having Heiken Ashi alone may not be enough to make a trading decision. So if you compare it with moving average crossover. So moving average crossover is basically taking 2 different time periods. One in this example, I'm looking at 9 period and a 20 period EMA lines. So moving averages, there's plenty of types. Obviously, the common ones are like simple moving average. The reason I'm using exponential, or we call it EMA for short, is because exponential will react faster compared to simple moving average or other types of moving averages. So moving average crossovers are simple. The moment the shorter term, shorter period cross below the longer term, it tells you that generally the market is coming down. So it's a bearish crossover. Vice versa, if the shorter term crosses above, that tells you it's pretty much a bullish crossover. And you couple it with that, which is your colored body bar of your Heiken Ashi, it gives you quite a reliable signal when to enter and exit the market. Okay, next we are going to introduce to you the third indicator on trend. Now this DMI is the main purpose is also there's two purposes. One is for trend direction and one is for gauging the strength of the trend. Now, my focus of using DMI is actually to gauge the strength of the trend, less of getting the trend direction, because you have the moving average crossover and Haken actually to tell you that. So sometimes if you put DMI, you can get a bit of overlapping signals. So this is what I meant. The bottom panel here, so DMI consists of 3 lines. We have the red line, which is we call it minus DI or negative DI, the green line, which is positive DI, and the black line, which is called the ADX. So you can obviously do if you use the positive and negative DI, you can obviously use as a crossover. So here is a classic example. We have the red line crosses above the green line, which means the minus DI is negative momentum is stronger. So market is likely to come down. And you can see it's the same signal as it gives to you during a bearish crossover and moving averages. So the positive, negative crossover on DMI is actually quite overlapping with your moving average crossover. So in a way, it's giving you similar signals. So in a way, you can ignore it and using DMI purely for the purpose of looking at the black line. Now, this black line is crucial. This black line is what we call ADX. So in this example here, we have red Haken and Shibas. It's a bearish crossover. It's a good entry to go short. Now, if you start to see this black line rising, it's telling you that this downtrend, there's strength. And this line will start rising until it reaches peak here. So this peak here coincides with, you start to see Haken Ashi candles are slowly starting to get small and it's likely going to be a sideways market. So this ADX also tells you potentially how strong is the trend going to be. And I think it's important. So like for this example here, you saw there's a bullish crossover on the moving averages, also on the DMI. And what is key is that this ADX or the black line starts to rise. So it tells you that this bullish uptrend momentum that's starting to gain strength. So it's a good entry point for you to be in the market when you start to see ADX starts to rise or the black line starts to rise. Okay, just to highlight again the same point. So ADX can rise whether it's a downtrend market, uptrend market, doesn't matter, because the main purpose is to gauge the strength. So right here we have a downtrend entry. And you can see that the ADX is rising, is telling you that its bearish momentum is still strong until the peak here, where ADX starts to come down. It's telling you that this downtrend market is probably going to take a rest. It's on a sideways market for now. So this is a good time for you. If you're holding short, it's a good time for you to be out of market. Okay, so a sample of entry setup here. This is a very good setup because you can see suddenly there's a long green Haken Ashi bar after a series of red Haken Ashi candles. So it tells you that, generally this market, suddenly there's news coming in or whatnot, it pushed the market higher. So with green Haken Ashi bars and a bullish crossover and moving averages is a good signal to take. But what's key also, look at ADX. ADX is also rising. And I think it's important. Now, I just want to add one more point. ADX is usually calculated by a number. So anything, based on market notation, ADX, any value that is above 25 is telling you there's trend. Anything below 25 is telling you there's no trend in the market. Now, I would say backtest, use those numbers to backtest. Some markets, even above 20 can be a trend market. Some markets, it's very rare to see anything that's above 30, but I think between the range of 25 to 30 to indicate there's a trend in place is a good number. So it's fair enough. If you see ADX number above 25 and it's rising, it's telling you that this uptrend, there's strength into it. So if you're holding or you're thinking to take a long position, it's a good time or good point of entry to be in the market. Okay, last bit, we must always have a plan to get yourself out in case the market go against us. So one of the ways is look at ATR. ATR stands for average true range. It means that it's actually measuring the high and low or the range of the day, the true range of the day, because it includes yesterday bars as well. Because of that, I think that's also important for us we always have, maybe the audience will have many ways for it to get you out of the market. Whether it's psychological stop, whether it's numerical stop, you hit certain amount, it should be out of the market. Now, all this requires discipline. And trust me, I think human discipline is a very hard, or rather is quite influenced by emotions to a certain extent. So having a proper strategy by just looking at, let's say, for example, in this example, it's looking at ATR, the multiples of ATR, can, in a sense, train your discipline to make sure that you're be out of market if the market go against you. So based on the previous chart we saw, there's a long entry setup at 70.42. If the ATR is $1, and you look on the risk to reward of 1 to 2 multiple of ATR, that means you are looking at a dollar risk for $2 of gains. That's your risk to reward ratio. Now, risk to reward ratio again is depending on individual. It can change. So that is important to take note, but at least you have a framework in mind, and that's important. So this is, I highlighted the lines. So your green lines are basically your target profit area. Your black line is your entry. Your red line is your stop loss level. So I think this market, this upward trend breakout is quite sustainable because you can see ADX is rising. The Heiken Ashi bars are still green, and the bullish crossovers. Also important to take note, the candles are using the average as the average line, moving average line as a support. The candles didn't break the support level. So in a sense that your moving averages can also play as a support and resistance area as well. So in this example, we managed to hit $2, our target level. But always more important is that you always maintain a one target stop loss price level. So in case anything happen, if the market were to reverse, your stop out at $1 below your entry. And that's very key. Okay. Now, one thing to take note, if you're using ATR to manage your risk, when markets are more volatile, that means your ATR value start to rise. And that usually means that you are preparing to pay much more. So it's good and bad. So more volatile period, you're preparing a bigger buffer, and therefore you need to expect to suffer a bigger loss. Now, if you're not comfortable with that, you can lower down your multiples over ATR. Again, you can use that same principle, but on a smaller scale. So that's importantly, you must have a plan to get you out of the market in case the market go against you. Okay, so I think that bit we have covered on the technical part. I just want to also highlight, why is it a good time to be in the oil market? Not only that prices are volatile this time around, but I think really with CME micros introducing all the micros products in a sense that is making it more is making it more bite-sized and giving the traders the chance to scale up their positions. Imagine those days if I were to trade one lot of crude oil contract, the margins as required is actually quite heavy. So a lot of people won't want to dabble on the oil market. But right now, if you want to start to understand how the oil market works, you have the micro contract that's available. And because of the low margin requirements, it gives opportunity for traders to actually try to understand how the dynamics of the market works. Those days, if you want to try, it's not easy because the margin requirements are very high. Now, obviously, micros are pretty new. They are new in the market. So the next question is always, is there volume? Is there liquidity? If you look at the average daily volume on a micros WTI, I think the ADV is about 90 to 100,000 contracts. I would say it's a very liquid market. Even the open interests are within the region of 18 to 20,000, which is, there's a lot of breadth and depth. So no, I think there's no issue or concern about liquidity. Now, these are margins. I think the margins to trade a lot of one lot of micro WTI is roughly about $600. Now, margins are variable. They do change time to time. So do get the latest margin from Phillip Futures. They're able to give you the latest margin. But I would say it's a very bite-sized, small-sized contract. You're able to take it. Obviously, one tick movement is equivalent to $1. And I think that's more able to withstand because the average daily range for oil prices right now, probably they're doing about $2 to $3. So you're probably risking about $200 to $300. So that's the amount of scale that you can scale up by using micros. I'm not going to go too much on the contract specs. You can get more information from Phillip Futures. They're more than happy to share with you. So if you ask me where oil is going to hit in the next couple of months or so, right now, if you look at it, the downward support is still between a 68 to 67 price level. If it does break that, easily you're looking at pretty much a downtrend market for oil for quite some time. And psychologically, a break below 60, if you look at the charts, look at one of the thing I mentioned earlier on my slides, if oil is trading at 60, I would say probably, 50% of oil companies in US is only making money. The rest of it are going to be suffering losses. So that's the dynamic of it. Now, do I think that you go down to that? It's unlikely. I still believe that with all this tension that's happening, it's what we are going to see in the market. We should see, prices, oil prices to be well supported into 2025 as well. Okay, so conclusion, I think the current gold stock levels are tight. So despite we are seeing a lot of negativity talking about huge supply coming in, low demand next year, we have to acknowledge the fact that stocks levels are still very low. Unless there is massive effort to replenish stocks in the next couple of months, then things might take a turn for a better. Now, OPEC supply is a very mystery. So I would say lead up to the first week of December is going to be crucial. And I personally believe that I don't think OPEC is willing to give market share or sacrifice market share to the US. And eventually, I think they will have to supply to the market. And when they do that, that will push prices down. Now, topic on green energy, EVs and all this, is it a major threat to oil? I would say it's not for now, because oil is not only mainly used on commercial vehicles. The biggest demand is coming from energy usage, industrial, and obviously the airlines as well. So as long as the demand for mineral energy, the need, the rapid need energy demand is still there, there is always a case for the energy market, the oil energy market. Now, geopolitical risk is something that is unpredictable, and I don't like it. Obviously, but as a trader, we just have to withstand, manage our risk well with this kind of market. So keep in mind, I think, we a volatile market like this, geopolitical headwinds is continue to be something that is going to be, whether you can say support prices, but it's definitely going to swing market momentum. If you ask me, I think the 65 oil price level in WTI is a very good level of support. I don't think it'll break in the near time soon. In fact, I still think prices may go higher because of the headwinds that we are seeing in the market. So keep in mind, next week, important date for US, and I think that will also be impacting the oil market. I just want to end with this slide. I think I just want to emphasize this to the audience. So for those who are new to trading any markets, or even new to trading futures, I always want to put this point across. Risk management is always key. So I just want to give you two quotes from two legendary traders. One is Paul Tudor Jones. He always say this: don't focus on making money. I think focus on protecting what you have. And that's the rule of a trader at the end of the day. There's no point for us to keep emphasizing, oh, this is how much I make, this is how much I make. But if we know, the key thing is always we need to ensure that we survive. And how we do that is to have a proper risk management. Now, if you have not seen this book called Best Loser Wins, or you've not read it, I'll highly recommend you to go for it. If you want to know more about risk management and trading psychology, I think Tom Hogarth's Best Loser Wins detail it very well. So I just want to share a quote from him. He always believed in defining his risk. It's never about the reward. So I just want to put that point across to the audience. At the end of the day, it's never about the P&L. It's more important about your processes, and in fact, you make sure you have a process to manage your risk, because once you manage your risk, your reward will come eventually. So with this, I'm just going to end here. I will hand it over to Tommy for the next session.
Yeah, thank you for sharing such fruitful material, David. Okay, we move to the second session. Wait, I will share my slide first. Okay. Before we move on the Q&A session, allow me to briefly explain the trading platform we use and share some exciting promotion exclusively for tonight's webinar. Okay, these are our introduction to crude oil futures product. What the advantage of the trading crude oil futures product? You can trade both direction, whether the market is going up or down. Is it a two-way trading transaction? Then the second one is get access to the global market products. and enjoy lower transaction costs, no overnight or swap fees, and real-time pricing. You to up-to-date market info to track movement. Now, here the specification contract. Actually, we provide the three size: regular, mini, and micro. But for the popular product is divided in two size, is a regular one and the micro one. For this time, this explanation focus on the micro size, where each contract traded represent 100 barrels of oil. For micro WTI crude oil futures, the initial margin for one lot is set at a $644. Additionally, the minimum tick movement for this contract is a 0.0 value at $1 per tick. Okay, trading for this contract will end either 3 or 4 business days before the 25th calendar day of the month preceding the contract month. Specifically, if the 25th falls on a business day, trading will conclude 3 business days prior. If the 25th is not a business day, trading will terminate 4 business days before 25th. Now, here is a profit calculation simulation. Okay. In the profit calculation simulation, if we open a sell position at 84.52 and close it 65.27, the profit obtained is around $19.25 after deducting the commission of the $3.8 per lot per side. The net profit is $1916.56. Conversely, if the market move against our position, we will incur a loss plus the commission fee. After understanding the product, let's explore why you should choose Phillip Futures for your trading needs. For the first, customer focus, we provide tailored education for both beginners and experienced traders, catering to your specific needs. Seamless onboarding process. Account registration can be complete in under 10 minutes. Powerful trading platform. All product and asset class can be traded on a single platform with charting supported by TradingView. We also offer 24-hour dealing support to meet your trading needs. Next, let's take a look at the Phillip Nova 2.0 trading platform. The Phillip Nova 2.0 trading platform is now available in both desktop and mobile version, allowing you to choose according to your needs. The desktop version, which you can see here, is very user-friendly. You can customize the placement of watch list, charting, and market depth according to your preference. Most importantly, the charting feature is integrated with TradingView, supported one-click trading. The mobile version also offers the same functionality as the desktop version, enabling you to use it anytime and anywhere. Now it's time for some good news for you, our promotion. Start your trading journey today. Seize new opportunity by opening an account with us today. Kickstart your trading adventure and gain access to premium tools and resources tailored to support your success. Open your account now and take the initial step towards reaching your financial aspiration. Enjoy competitive trading commission. Today, enjoy trading micro WTI crude oil futures with a super low commission of just $3.8. Take advantage of this opportunity to maximize your trading potential by opening your account now. Enhance your portfolio with a selection of trading spot products. Open an account today to access diverse spot products and boost your investment opportunity. Benefit from the personalized one-to-one coaching. Start your account today to benefit from exclusive one-to-one coaching, receiving personalized guidance to enhance your trading skill and optimize your strategies. Join our community for exclusive insight and support. Open an account with us today to gain access to our exclusive WhatsApp group. Stay updated with real-time news and insight on our website and social media, and enhance your trading experience. Now it's time for the Q&A session. Please type your question in the chat box. Mr. David Ng, could you join me, please?
Sure, yeah.
Yes. Okay. Here, I already get some question for you.
Sure.
Okay. For the number one, what prediction and reaction strategies can traders use to anticipate changes in supply from OPEC and other major oil producers given OPEC's evolving role in the market?
Okay. So I would say this it's very hard for us to prepare what or rather anticipate what OPEC will do. At the end of the day, make sure that you have a proper trade plan in place. Like I mentioned earlier, how you create a trade plan, looking at all the trend tools and make sure you have a way to using ATR to get you stop out. I would say it's very difficult to anticipate what OPEC will do. But I would say this is that I think judging from where OPEC is, going into next year, if they decided probably by early December they decided to release more supply into the market, I think that will create a lot of volatility in the oil market. So, whether can we fully anticipate or prepare for this, I think it's difficult. But I think what we can do on our part is make sure we have a proper way to manage the risk in case anything goes wrong. You get stopped out. It's fine. Look at the next opportunity. At least you take this loss, look for the next best setup. Markets opportunities are always there. So I think it's more important is how you manage your risk. Obviously we can't anticipate every move from OPEC. But I would say it's going to be quite significant going into next year what OPEC will do.
Okay, thanks. For the next question, can you elaborate on the current correlation between oil price and equity markets? Are there specific sectors that are more sensitive to oil price fluctuation?
Okay, so I would say this. Now I think it's getting very tricky. If you want to find relationship between oil and equities. Now in those days, they tend to move in line, which means that equities market usually is a barometer of your economy, health of your economy. So if your economy is weak, you expect equities to be weak, and that also means less demand for oil, therefore oil prices are weak. Right now, we don't see that. There's clearly a divergence between how economy is performing and real economy is performing as compared to where equities are. Equities are at all-time high, but oil prices are not there. So I would say oil prices, as what it's saying, is a more truer reflection of where the general health of the economy, while equities is more driven on the optimism that's created by whether it's from monetary policy or on the outlook of different other variables. But I think there's clear divergence there. Now, second, I think to answer the second part is that I would say how would that impact oil prices? You see, a lot of companies, not excluding oil companies, they will prefer a low oil price around because that keeps your inflation low. So I think generally if you have a low oil price environment, that will benefit quite a lot of other sectors. But when you have rising oil prices, so sectors that use a lot of oil because it's your input cost, you definitely have rising input costs, and that will definitely erode into your earnings. So in terms of sectoral impact, I would say this, if you have right now everybody's talking about AI boom and all this. There's no clear relationship between AI sectors and the oil market. But I think if you see rising oil prices, I think that will affect a lot of many other industries, except the oil producing sector. So I think that's something for us to take note in relation to the equities space.
Okay, thank you. This is a very interesting topic and so many questions queue for you, Mr. David.
Sure.
Okay, for the next one. How fluctuative the oil price could be if not only about the geopolitical tension between Israel and Iran that is happening right now, but the new organization BRICS. What will be the impact to the crude oil price? Is going to be a positive or negative sentiment?
Okay, that's a great question. I mean, my opinion on this is this. I think
It's okay.
BRICS is trying to gain more prominent, try to be an alternative block to the legacy blocks that we've seen in the past. Now, how would that impact the oil market? I mean, I don't claim expert to be this field, but I think my opinion is this. There's always a talk where, you know, now we are talking about petrodollars. Everything is denominated in US dollars. Having BRICS coming in when they trade between their nations, whether that will erode the strength of the US dollar, possibly yes, because these are all huge trading blocks. These are big countries, they are not small countries. If they start to trade between themselves using currencies non-US denominated, I think that's where it's a serious concern for petrodollar. But how would that impact oil prices? I think that's a whole different story. Now, eventually, I think the BRICS consists of countries that are also quite large in terms of consumption. So if they decided to divert, you know, their focus away from, you know, generally from other suppliers, I think that will probably be impacting prices. But I would say totality, there's not much of a net impact. Whether it's positive or negative, there's not much of an impact because these countries are still demanding more or demanding less. Is having a block like BRICS is not going to change the dynamics of demanding more or demanding less. So ultimately, it all points down to the supply and demand. So regardless, I think having the BRICS involved is mainly down to the payment denomination. If they decided between their countries to use a non-US denominated form of payment, I think that's going to be a challenging, you know, on a lot of fronts. But I don't think having BRICS as a block will impact much on oil prices.
Okay, I see. Thanks. Now, for the next question. In a crude oil market with short-term bullish trends, but a long-term downtrend, what are the practical advantages of using technical tools like Heikenesi and moving average for setting up a trading plan?
Okay, that's a good question. So I would say this, if you look at my examples I presented earlier,
Yeah.
just to highlight the time period I use is between sometimes an hour or 30 minutes time frame. So these are what you call short-term view of the market. Now I agree. You look at on a daily basis, the daily chart shows you on a daily period, the oil market is still on a bearish move. But as a trader, we don't look at if you are a short-term trader, intraday traders, we don't look at we obviously we use daily chart as a reference, but when we make trading decisions, we look at smaller time frames. Now, if you look at the examples I've given, some of them are 30 minutes to an hour time period. Now, I wouldn't recommend anything below that because you get a lot of whipsaw signals. So I would say this, there is still trend persist. There's still trend that can show, I mean, short-term trends are still noticeable in a shorter time frame, like example, 30 minutes to an hour. Now, having obviously the outlook of a bigger point of view like daily will probably point your focus. But I think even looking at 30 minutes, sometimes there's trend that you can see trend involved by looking at Heikenesi. I think that's where opportunity is present to you. So I would say this, if you are intraday traders, you know, you are looking at charts on an intraday basis, you have to look at smaller time frames. You can't be looking at daily because that means you're carrying positions overnight. And as an intraday, you don't want to do that because carrying position means higher risk. So I hope that give you the context of the question and answer to the question in some parts.
Okay, noted. Okay, for the next one, how is the green energy transition likely to impact crude oil demand over the next decade? And which specific sectors are expected to play the biggest roles in reducing oil demand?
Okay. Okay, if I get the question correctly, is how will green energy impact oil demand in the future? Am I right?
Yes, the main point is yes.
Okay. I would say this lah. Obviously we are feeling a bit of impact because you just look at how EV sales is in whether it's in China and US, they're massive. I think their growth year in, year out is tremendous. So that means adoption of EV is also getting higher. And countries are also talking about climate neutral, climate friendly, climate positive. That means away from fossil fuel. Now, if you just look at numbers alone, whether it's from OPEC or what, the jet fuel demand, heavy portion of it, easily about 30% of total global demand is huge. So it tells you that, you know, people are still flying, they're still using fuel, which is an important source of energy for them. And that still is generating still a good demand. And in fact, numbers are back to pre or even better than pre-pandemic levels. So it goes to show there's still relevance of using mineral. And now obviously there's talk on energy demand is rising rapidly because people are talking about we need more energy, we need more energy capacity to generate more energy for the world demand. Now there's many ways, there's alternative energy and there's fossil fuel energy. Now we can't discount the fact that fossil fuel energies are still very reliable and it's very stable. Now as long as the demand is rising, and I believe mineral energy is a good way to fulfill those gaps. Now, going forward, I think many countries are slowly starting to shift. Alternative energy space are also coming in strongly. And I think whether I can't pinpoint when the exact timing is, but I think easily probably in the next 5 to a decade or so, we really will start to see demand shifting away from fossil energy, and that's going to be a major trend. But until then, I still think oil is still an important play. Despite we are seeing the EV scene that's gaining more popular. Now, as to the sectors that can benefit, I have to admit I'm not an expert in looking at which company is strong in EV play or what. But I think the green energy or the green narrative is important to talk. But again, it also boils down to who's going to win the US election. I mentioned earlier, President Trump is always if he wins the second round, is always against the green energy guys. While Harris, on the other hand, is very friendly. So that will also be quite a major determinant because US is a large country. It drives policies for other countries as well.
Okay, thank you. And the last question. What practical trading strategies should be traders adopt to manage risk in the face of unexpected supply shift from OPEC and major oil producer?
Okay, could you repeat that question again? Sorry.
What practical trading strategies should be traders adopt to manage risk in the face of unexpected supply shift from OPEC and major oil producer?
Okay. I would say this. One good advice is when it comes to OPEC decision days, like I think the first one, the upcoming one, should be early December. I'm not sure when the exact date, but I know it's the first week of December. Avoid those week. Avoid trading crude oil on those days. If you don't like volatility, you don't like, because the decision can be swing either positive or negative. Obviously, there's an onset of building momentum towards the day. But I think if you don't like big swing or in the market, avoid those OPEC days, OPEC meeting days. Now, other than that, also importantly, if you're trading oil market, there's obviously the key US economy report days, like the first unemployment report is out on first Friday. Avoid those days as well. Now, I would say that's a safer strategy that you can use. Now, to really mitigate the risk, one good way is also look at options. Diversify the way or efficiently manage your risk using options is a very good tool to use as well. Or to make sure that you have a plan to keep yourself out of the market in case the market go against you. Always remember this. You can be wrong. Market is always right. You can be wrong. And when you're wrong, you make sure that you're wrong not too badly damaged, because eventually there is always opportunity that is coming to the market. So simple short answer is make sure you have a way to manage your risk. I shared earlier using ATS and multiple, that's one way. There's a lot other ways as well, but be disciplined in your approach, be disciplined in the process. And during time of volatility like this, make sure you have a way to get yourself out in case anything happens.
Okay, the point is we should understand ourselves and should manage the risk.
Definitely, yes.
Okay. Okay, Mr. David, this is the last question. Thank you for your sharing this insightful material on navigating the crude oil market. The focus on key market driver technical strategies like Heikenesi and robust risk management technique offer valuable guidance for trading in volatile environment. We very appreciate the practical solution for managing risk and staying prepared for the dynamics ahead. Thanks, Mr. David, and thank you. Have
Thank
a
you.
good evening. Bye.
Bye.
Bye.